Gordon Chang of Forbes.com, my colleague and co-host, is in Hong Kong. We're looking to the China story because it connects directly with the United States right now, with the sluggish recovery, with the new normal of corporate profits driving an ever higher stock market. At the same time, it's helped considerably by the Federal Reserve keeping rates at zero because of the sluggish growth. Charles Ortel joins us. Charles is going to comment on a phenomenon that is not easy to track. Charles is the managing director at Newport Value Partners. Charles, a very good evening to you. Softness in China, and I'm going to be very specific here. IBM is badly off in sales. So is Microsoft and Eli Lilly. The list is long, but I picked three of the premier companies in the United States. This is China market drop. First of all, can we castigate these companies for over-promising results from China without taking into account the business cycle? And secondly, what is the explanation for the sudden drop-off? Good evening to you, Charles.
Thanks for having me on, and hey to you, Gordon. I think that the business community, particularly the large, husky companies like the ones you mentioned, really have no excuse for misleading, potentially, the investment community for so long. I mean, there's a very simple phenomenon that's been continuing since perhaps before 2008, when here in the United States we suffered the dramatic declines in September, and that is that we've just been building up global productive capacity way beyond demand, particularly in a country like China, which is beset with demographic problems, potentially way too much debt on and off balance sheet. They should have known, these companies you mentioned, they should have known long before now that the opportunities certainly are not as rosy in China and some other emerging and rising markets as everyone had expected. The focus that most investors have is so surface level, just on top-line growth and on reported profits. Profits, which were way off for the companies you mentioned, don't tell the whole tale. Cash flows and free cash flows were likely much worse, too.
Gordon?
Charles, this is very important because the bad Q3 results from many U.S. companies are really just the latest quarter of disappointing results. We've seen this now since about the middle of last year, and the other thing that's happening at the same time is that Chinese companies also had very poor results for the quarter. So this is starting to be looking like the business cycle starting to bite U.S. companies, and as you say, they did not really tell the markets that this was going to happen, and they should have known that because many people saw this coming.
Absolutely. And John, actually, you put your finger, I think, on the most important button, and that is that the Federal Reserve has kept interest rates so low. It's not a question of keeping them at 9 instead of 10%. As you say, they're down close to zero, particularly when you think about inflation. And that is what's propping up asset prices and equity prices around the world. When you look hard at the Federal Reserve, there's nothing really standing behind the Federal Reserve that's all that solvent.
Gordon, I want to take these results. These are American companies. They report quarterly. They're very carefully policed and regulated. There's transparency. First-rate people, they report what they know at the time. However, in China, none of that is true. So is this a way of seeing into the Chinese recession that is denied routinely by the Chinese Communist Party?
Oh, yeah. This is very important because once you start looking at independent means of indicators, ones that are not controlled by Beijing, you start to see a picture of an economy that is stagnating. So, for instance, it's not only corporate results, both American companies and Chinese ones. We're starting to see the Beige Book survey was very, very disappointing. The HSBC Purchasing Managers Indexes, they're not very good either. And also job employment data, which is created by the central government, but not by the National Bureau of Statistics, the one agency that has really been in charge of fabricating these results. When we start looking at job employment data from China, it is showing an economy which is actually collapsing in the third quarter and in the second quarter. So this is quite serious, John.
Charles, I want your help with what appears to be a paradox to a reader. Executives say excess capacity in China, weak pricing in China have raised concerns that industrial growth is slowing. Okay, full stop. Then, China's manufacturing sector is just barely expanding. Do those things work together? Can you be expanding while you're showing a dip in industrial growth?
You can if you're funding your business with funny money. I mean, in the real world where you have to go and you have to explain to your investors what you did with their capital, you can't do things like you have to cut back capacity to meet local demand. But we need not jump just on China. If you look at the Federal Reserve data on the U.S., in the manufacturing sector in the U.S., we are still operating way, way below capacity. 5 years into an attempted restructuring.
Gordon, what does this say about the Chinese jobs market? Because as they, let's say, are less than truthful about their manufacturing and export sector, there's no vision at all that we can have into their jobs market. Does this tell us that jobs are weak and weakening?
Yes, it is, John. Data, which is fragmentary, of course, for the third quarter shows that there were fewer jobs in China in the third quarter of 2013 than they were in 2012 in the third quarter, and that was down 2.5%. Also, the jobs in China in the third quarter of 2013 was 4.0% less than the number of jobs in the second quarter of this year. That is really stunning. This follows a year of poor job creation in 2012. The number of jobs in China in 2012 over 2011 was up, but only by 0.37%. 0.37% increase, 2012 over 2011. That is a real tell. It shows that the Chinese economy is stagnating and that these wonderful rosy numbers we've been getting out of Beijing just cannot be right.
Charles, I've learned that the Federal Reserve is a helping friend when you're on the street. However, what's best for corporate profits is customers, and what's best for customers is jobs. So I think what we're seeing in China, that the reason the U.S. corporate profits are down is because the jobs market is weak and because you can't cover up the fact that people aren't buying by printing funny money the way you indicated.
You're exactly right. I mean, the one curve that people are not yet talking about and that they should talk about is that the cost of employing people everywhere around the world continues to rise, whereas the cost of replacing people using technology, using machines, is falling, even in a place like China, perhaps especially in a place like China. So there's this mismatch, and politicians aren't being honest about it. Big companies don't actually have to report good, solid results by geography, and that's something out of the next wave of this downturn that I think could change radically.
Gordon, the last 15 seconds. The U.S. company profits are down in China. Will it continue? Is this a downtrend that has no stopping?
Yeah, there's no stopping for the foreseeable future, John, because the economy is just not creating jobs, not creating profits.
We will speak to the Chinese reforms forthcoming later in the show. Charles Ortel is managing director at Newport Value Partners. Gordon Chang of Forbes.com is in Hong Kong this morning. I'm John Batchelor in New York.